Good morning and welcome to the Energy Perspectives Group webinar hosted by Earthstone Energy. This event will be recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here is Dan Steffens, who will introduce today's speaker.
Hi, everybody. And for all of you that live in Texas, I hope you survived this Arctic blast and weren't out of power too long. We were out of power about 20 hours yesterday, but everything's back up now. So anyway, this morning we have Earthstone hosting this webinar, and Earthstone, which their symbol is ESTE, opened at 681 this morning, which compares to my valuation of $10, which was done at much lower commodity prices than we have today. So our speaker today is Robert Anderson. He's the president and CEO of Earthstone Energy, which is one of our Sweet 16 growth portfolio companies. So we've been tracking it a long time. Robert has a bachelor's degree in petroleum engineering from the University of Wyoming and an MBA from the University of Denver. He has over 30 years experience in the upstream oil and gas industry. Early in his career, he was petroleum engineer for Anadarko Petroleum, Arco International, Hunt Oil, Yucatan Energy, and Pacific Enterprises Oil Company. He joined Frank Lodinsky's team in 2004. He was involved in the acquisition of Southern Bay Energy as vice president of acquisitions, and then Southern Bay merged into Geo Resources in April 2007. And I started covering Geo Resources in 2008 and put it into our Sweet 16, and we did quite well on the stock. I think it tripled from the time I put it in there. So I've been tracking it for about 12 years. Geo Resources merged into Halcon Resources in August of 2012, and Robert worked for Halcon for about 6 months as executive vice president and chief operating officer. Then in March is about 6 months, 7 months later of 2013, Frank put his team together at Oak Valley Resources, and Robert was the EVP of corporate development and engineering. Oak Valley then merged into Earthstone Energy is how it went public. And since then, Earthstone has closed several significant acquisitions, including the acquisition of Independence Resources Management, LLC, that closed just in January 7th, just last month. So Earthstone currently has approximately 19,000 BOE per day of production, with about 53% of that being crude oil and the other 47% split evenly between natural gas and NGLs. Robert was promoted to president and CEO of Earthstone in April of 2020. So we'll turn it over to El Presidente. So Robert, it's all yours.
Thanks, Dan, and I appreciate you hosting us today, and appreciate that introduction. I think you've given enough of my background. I can skip probably 3 or 4 slides in this whole presentation, but I will tell you a little bit about our management team and track record. So I'm pleased to be here today. And for, as Dan mentioned, for you in Texas, I hope that when you do listen to this later, because you're probably not listening now, that you came through at least with as minimal damage as humanly possible. I know we were out of power, like Dan said, as well for a few hours. And I also have my fair share of broken pipes and some water damage at different places. So I can sympathize with all of us living in Texas. Having been in Wyoming and Colorado and Utah and North Dakota through my career and growing up, it's amazing that we get to low temperatures in Texas and we have pipes bursting everywhere. And up there, I was seeing temperatures that were, 20 degrees below zero, and we never had these same kind of problems. So it's different everywhere. So on slide 3 here, and I assume everybody can see the slides if they're watching or will when they listen along, is our disclaimer and just our legal forward-looking statement slide. So Earthstone Energy, who are we and why are we here today in the environment that we're several factors play into that. We have a long track record of being in the public markets. We have a long track record with investors who are repeat in not only Earthstone or Geo Resources, but even going back prior to that. And one of those track record investors that Frank talked about early on in the georesources days and early on perhaps in Oak Valley and Earthstone with Dan and in these seminars is the Vlasic family, who at one time owned the pickles that you get off the shelf. They've been with Frank and our team for about 30 or 32 years, investing in oil and gas only through us. So that track record is very important to us. And we'll talk a little bit more about that as we go through the presentation. Another thing that is a characteristic of Earthstone that might set us apart a little bit is our financial discipline. And a lot of what you see on page 4 here highlights those factors of financial discipline that have set us apart from the small cap peers that are out there and create us being in the situation we're in today, and even going back a few months when we announced the IRM acquisition that Dan talked about. We actually came out of 2020 better financially than going into 2020. So we're starting out 2021 in a great position, and we'll talk about consolidation and what we believe is an opportunity for us. And then lastly, from a track record and an important characteristic standpoint is our focus on operations. And that's not only the day-to-day producing operations, which we'll talk about, but it's also the drilling and completion efforts that we spend capital on, and we focus very much on that. Being a small cap company has its challenges in the public markets. Sometimes you don't get a whole lot of attention, but thankfully, being a survivor and a thriver in 2020, we've got the ability to attract investors with a very clean company and a very great platform to take us to the next level. This slide on page 5 just highlights the track record and time that we've spent together. Dan talked about Frank. He's been in this business for close to 50 years now. He's executive chairman. I've worked with him for over 17 years. And in fact, Steve Collins, who now is our longest tenured employee with Frank, Steve and I worked in one of those many companies that Dan talked about in my background. Steve and I were both at Pacific Enterprises and Hunt Oil Company years ago and went separate ways and then came back together. So from an operating standpoint, Steve and I think a lot alike, and he handles all of our operations. And you can see the other tenured employees here at the management level. So we believe that not only investors and the long-term standing we have with those is important, but our staff as well. We have guys in the field who have been with us for over 20 years. We have folks in the office who have been with us for over 20 years. And we're continually, over the last few years, adding to our staff and some of the younger talent that is out there that is just quite incredible and talented to bring along. So one other important factor about alignment with shareholders and track record is how we look at executive compensation. And we have always been fully aligned with shareholders. We as management and even down into our staff are compensated with equity more so than we are on the cash side. From a cash component standpoint, we are at the 50th percentile or less, depending on the job, or at least in the management ranks, we're definitely below the 50th percentile on cash. But when it comes to equity, if the investors can't make money, then the management team shouldn't be paid just to sit in their seat. So we have a strong alignment in our equity compensation program where that target and payouts are based on absolute shareholder returns over 3 years. We've gone to this program in the last 2 years now, and we definitely set leading practices amongst small cap and maybe even large cap companies in terms of how we recognize the investors' demands and went away from relative shareholder returns and fully discretionary cash bonuses to absolute shareholder returns on the equity compensation and performance-based cash incentives that have targets that have to be met before those payouts can actually occur. So again, another example of how we as a small cap company are focused on alignment with shareholders. So how did we do in 2020? Well, we haven't finalized all our numbers yet. We'll provide our 10K and earnings results and release in the first half of March, probably closer to the 10th through the 15th, something like that. But we survived 2020 quite nicely. This slide on 7 shows you that oil prices dropped 30%. CapEx on our side, we abruptly stopped our drilling program in May. We announced it in March. We were on a 6-well pad. It was a little operationally difficult to stop in the middle of that. So we drilled out that 6-well pad and released the rig. We only spent about $68 million, a 2/3 drop from the prior year. LOE and G&A continued to work very hard in 2020 to drop those numbers, and you can see the results there. Again, this is year to date through 9/30, and then consensus or guidance for the last quarter. However, production and CapEx have already been announced, and you can see we were up on production 15%. And our EBITDAX for the year is going to end up basically flat. So a huge reduction in oil price, a huge reduction in CapEx, growth in production, and flat EBITDAX, and reducing our leverage all the while because of this huge amount of cash flow that we generated during the year. How do we do that? Well, again, that's part of our financial discipline, and hedging is a big piece of that. And we'll talk about that as we go through here. The volatility in oil prices on page 8 really started in 2014, towards the end of that year, when we rolled our private company, Oak Valley, into Earthstone. And ever since that time, we've developed a strategy knowing that this is a very cyclical business and very volatile business, and leverage will put you in a box very quickly. So we manage our business in a $40 to $50 to $60 price environment. And every chance we can, with oil prices over 50, we're going to take a little bit of that risk off the table by hedging. How has that translated into what our numbers actually looked like over this time frame since the beginning of 15? Well, as Dan mentioned, we did do several acquisitions along the way. In June of about June of 16, we closed on an acquisition of a public Canadian company, Linden Energy, that was all non-operated in the Midland Basin. And that was our foothold to get into the Midland Basin. And we had been studying the basin technically and understood the resiliency of that basin at low oil prices. And then in May of 17, we acquired Bold Energy, which was a primarily operated business in the Midland Basin, and gave us our big operating position. And since then, we've done some smaller deals. We sold off some assets that were non-core, like in the Bakken and non-operated Eagle Ford and East Texas and Oklahoma, the kind of the starter kit we had at Oak Valley. And now we're primarily focused in the Midland Basin with some assets in the Eagle Ford. You can see what our production's done along this time frame. But more importantly, what has our leverage done? Again, we focus on this in every deal we do. And when we get to some details on IRM and that acquisition, we'll talk about that. But you can see that our leverage over this time frame has never really been over about 1.2 times, which historically, that's how we've built our companies, and always considered leverage, liquidity, and our banking, our debt, when we consider opportunities and acquisitions. The company overview on slide 10 just gives you a snapshot of where our acreage is located in the Midland Basin, and then a little bit about our size. Dan said we opened up a little less than $7 a couple days ago. We were $7 a share. We have about 78 million shares outstanding. Sometimes it's confusing to investors, this Class A, Class B. The Class B have the same rights as an A. They just don't trade. They don't have any more voting power than an A. They get the same one for one voting. And that's a tax deferral Up-C structure vehicle that we used when we bought assets in 2017. And those 35 million shares went into this Up-C Class B categorization. So they eventually will be converted to A at the holder's own timing and request. But that gives us, you can see, a market cap of about 500, and we'll round it to $550 million, and an enterprise value of 790. So sort of keep those two numbers in mind as we go through when I show you some reserves in a few minutes, because our proved developed reserves are currently trading. We're trading our proved developed reserves, which are about $650 million and a $50 flat price deck. And as you all know, the price deck is much higher than that. So let's talk about independence for a moment. Given the factors that I mentioned earlier about our track record, alignment with shareholders, strong financial discipline, and strong operations, we were on the hunt all of 2020, trying to find opportunities to acquire assets and gain scale. As our small cap public company, and maybe even in parts of 2020, we were a micro cap. Being small had its challenges, as I mentioned, and so we're looking for scale. And scale can come in lots of forms, but what we really focus in is on cash flowing assets. The IRM acquisition fit that to a T, in that it had strong cash flowing assets, but it also had very good drilling opportunities that would fold well into our drilling program. The IRM deal increased our size by about 50% if you look at production and adjusted EBITDAX. Again, financially focused on where our leverage was going to come out. And at the end of the third quarter, on a combined basis, we're about 1.1 times leverage. And lastly, it was accretive to all our financial metrics, including, given that we got some more production and our G&A is not going to go up that much, our cash G&A per BOE is going to be on the order of 25% less. So it fulfilled all the attributes of an acquisition and consolidation that we were looking for. A little bit further on the consideration, I said it was about $183 or $182 million. It was cash and stock. The cash portion, 131 million or so, was actually funded through an increased revolver. We went from $240 million revolver up to a $360 million revolver in conjunction with the closing. So we got our banks to increase our reserve-based loan to $360 million, and we used that incremental cash there to fund the cash consideration of the IRM acquisition. And then we issued 12.7 million shares of Class A to the seller, which is primarily owned by Warburg Pincus, a big private equity firm out of New York who's been involved in oil and gas for a number of years. So one of the compliments that we as a management team and company get out of doing deals like this, where a big private equity sponsor takes shares in a company like us, is they recognize the undervalued nature of our stock, and they recognize the quality of our management team and asset base, and they recognize the platform that we are in the process of building, or at least that we have, and that we're going to continue to build. And so that was a great validation of the asset that we were acquiring to bring in another private equity sponsor. This, like I mentioned earlier, really boosted our scale from an operating standpoint. And I'll show you a slide in a moment or two. It really gave us a re-rating on our EBITDAX trading multiple. We'll show that in just a second. But the asset size at the time of the announcement, the third quarter, was producing about 8,800 BOE a day, about 16 million barrels. And you can see that the PDP PV10 is $173 million. So again, the asset was underwritten for the most part by PDP, and we paid very little for the upside. We got 4,900 net core acres in what we call the Spanish Pearl area on the Midland and Ector County line in the Midland Basin. If we zoom in a little bit to that map on page 15, you can see where that acreage is located. And what we really liked about this acreage is it's very de-risked. IRM or their predecessor had drilled close to 50 wells on this in multiple benches, being the lower Sprayberry, middle Sprayberry, and 2 benches in the Wolfcamp, as well as offsetting operators have continued to develop units offsetting this acreage position. And those companies are big public companies as well as some private companies. And a lot of the white space on this map where you don't see sticks, which are hard to see, but there's sticks on here, gray locations. Those are mostly public companies like Concho and Diamondback. XTO and Callan are also involved out here. And then the private guys, FDL is listed as well as Fashion. So these companies have all helped de-risk this acreage position. And we find that we've got 70 gross locations across here that we're pretty excited about. And we're going to fold in a 4-well pad this year in our drilling program. So again, I think I've talked about most of these. It increased our scale. It was quality acreage. It gave us some additional free cash flow that we'll talk about in a little bit. We maintained our balance sheet strength, and it did not impact our operating statistics, whether it's from the cost standpoint or the margin standpoint. I've highlighted this already, but you can see in the third quarter on page 17 how our numbers increased with the combination. They IRM brought about, like I said, 8,800 BOE today to us in the third quarter. In the fourth quarter, that production was down, and we ended up at a total volume of about 2,200 BOE a day combined. As Dan said, we closed January 7th. So we now sit in December 17th, closed January 7th, and we'll start reporting in the first quarter full numbers related to IRM. Page 18 is just a depiction of what we would have looked like standalone running one rig and what we would look like on the combination with IRM. Obviously, we'd have higher production and higher adjusted EBITDAX, but we'd also generate more free cash flow and allow us to pay down debt even faster or use that additional free cash flow for other opportunities, like bring a second rig into the field at some point, or find more acquisition opportunities, which we're definitely focused on. A little bit of how we've grown again, and most of this I've already touched on slide 20, but I just want to show you how quickly the company has ramped up and kept our debt metrics very solid over the same time frame. So I mentioned already that on a combined basis, the fourth quarter was about 22,500. On an adjusted EBITDAX basis, almost $250 million when you annualize or pro forma for the last 12 months on a combined basis. And one of the things we focus on a lot, as I've talked about, is lease operating expense and cash G&A on a per unit basis. You can see how those have been driven down over time, and we continue to work on those every day. So being a small cap has its challenges, but one of those challenges is being a good efficient operator. And slide 21 points that out. We compare ourselves against 10 peers that produce primarily in the Midland Basin. There used to be on this slide, if you went back to November or maybe October, I think there were 13 on here, but we've lost 3 due to recent combinations and mergers or pending in some cases. So we'll continue to have to update this list as companies sort of disappear. But you can see on the top slide section that through the first 9 months of the year, all in cash costs, including lease operating expense and workovers, taxes, transportation costs, G&A, and interest expense, we were well below the small and mid cap average of $15 when we sit here at $10.72. From a large cap perspective, we've got a little ways to go, but we're not too far behind them on the cash cost side. That is one thing that scale does definitely help, is when you think about your corporate structuring costs. But on a margin standpoint, and I've already mentioned this, we focus on making sure we've taken the price risk as much as we can out of the equation. And when you include hedges in our realized cash margins, we are the number one through the first 9 months of 2020 of all these 10 other companies, standing out quite a bit higher even than the large guys like Pioneer and Diamondback. So very proud of the fact that we drive a low-cost business into a high-margin business. The top of slide 22 just shows you where we compare through the first 9 months of the year on a debt to EBITDAX. Again, the lowest out of the entire group, including the large cap names. And then lastly, our trading multiple. We're trading about 4.7 times 2021 consensus for EBITDAX. And it's still below the SMID cap average and well below individual companies across here. If we would have gone back and I show you this slide from November, and probably you dig around a little bit, you can see it. We were trading at 2.5, 2.6 to 2.8 times, very undervalued. And the IRM deal helped, but the recognition by investors over the last, we'll call it 45 to 90 days, our trading multiple has really moved up as we've been highlighted as an undervalued stock. I mentioned this also previously, but we are focused on operational improvement continuously. And again, this is one area where only running one rig as a small company, you can't get the outsized efficiencies and scale economies that you would if you're a Pioneer or a bigger company. However, our statistics are pretty good and we continue to work on the efficiency. We see costs in 2021 on a 10,000 foot lateral running one rig under our cost structure, somewhere between $650 and $700 a foot. There are companies out there who have lower cost structures and economies of scale. And so that number is probably $600 a foot or less for some of those companies. Pad sizes go into that. The bigger the pad size, the more efficiency you gain and drive down some of that cost. But then the cycle time of getting wells online is it offsets that and it takes longer. So as a small company, we're probably going to manage that size. We've drilled pads as big as 6 wells. Very infrequently have we and will we drill 1 well pads going forward. That's just totally inefficient and probably not the best thing from a reservoir standpoint. The all-in frac costs per stage have really driven our total cost structure down in the field. And you can see that we're forecasting about 40,000 per stage, up a little bit from the fourth quarter. And that's just a little bit of inflation built in there. And then lastly, on operations, we are focused on environmental responsibility. It's something as an industry that doesn't get highlighted how well we have done. We just get beat up for not reporting it very well. As a small company, we continue to get more of our oil on pipeline. We're over 60% for this year. And eventually we could probably get that number to 70 or 80%. We do have 100% of our water disposal on pipeline. And that's very important to reduce the amount of truck traffic and CO2 emissions. So we've done a good job and we'll continue to improve on this as both an industry and at Earthstone, and it is a focus. Slide 25 just shows you our operating areas and shows you the relative contribution of these different assets. The Eagle Ford is, very small now. It's only about 5% of our production. Our legacy Midland Basin assets are the biggest. And then we have the IRM assets. And you can see at this price deck, $50 oil and $2.50 gas, how those numbers turn out in terms of proved developed value. And we actually give you a table on page 26 of our reserves. The top section of that table is Earthstone standalone year-end 2020 SEC proved reserves, straight out of our colleague Gillespie reserve report, and will be included in our 10K. And then the bottom section is related to our combined reserve report at $50 oil with IRM in there. So you can see that $652 million number I mentioned earlier is proved developed, and our market cap is only about 550. So we're trading below our proved developed reserves. We've got a substantial inventory in the Midland Basin, and that's where our capital for the foreseeable future is going to be spent. We won't spend any meaningful capital in the Eagle Ford. And we really like the economics at $50 oil. Like I said earlier, the resiliency of the Midland Basin in down to $40 oil, or maybe even a little bit less, makes you want to participate in the economics out there, and makes that basin the premier basin to operate in. So you can see our returns in Midland County and our returns in Upton County are really good, and that's where our capital is going to go in the near term under a 1-rig program. And then over time, our biggest inventory area is probably Reagan County, and we have good returns there, but we're going to start with our highest returning project areas. A little bit about our budget. We've given guidance and budget numbers out already. We're going to spend about $100 million in 2021. The majority of that going in the ground and drilling and completion. We do have some infrastructure dollars we'll spend as we go into areas where we need to just increase our frac water supply. With that, we expect production between 19,500 and 21,000 BOE a day, and we'll be a little bit over 52 or 53% oil. And then from a liquidity standpoint, the combined company effective as of 12/31/2020 has about $260 million of debt. I told you we had a revolver of about $360, so that gives us $100 million of liquidity on the revolver and then the cash. So we've got plenty of liquidity, given that running a 1-rig program, we will generate good returns and have plenty of free cash flow. The last thing I'd say about that is even if we ran 2 rigs under the current price deck, we could still have a little bit of free cash flow in 2021, depending on when we started that 2nd rig. But our plan is to start our rig program later in the 1st quarter. So, within the next month to month and a half, we'll be drilling. We're in the process of fracking 5 wells right now, or actually we've fracked them, waiting to drill those out. We'll probably get started next week after things thaw out a little bit. And so we'll have 5 new wells brought online in the 1st quarter. And then we'll generate a good drilling program throughout the year. And hopefully we'll be able to beat this production that you see here. The last slide I'll end on is just our hedge summary. Again, I've harped on this a little bit, but financial discipline, hedges go into that. We're very simple, 100% swaps. We like to hedge when oil's over 50, and we like it even better when oil's over 55 and continue to hedge. We've got a pretty strong hedge position in 21. Probably 80% or so of our production is hedged, and we'll continue to layer in 2022 volumes as we go through this year. So with that, Dan, I think I ran over a few minutes, but I will turn that back over to you and let you take it with questions.
Okay, Robert, good job. I've got a few questions of my own here that I'll start with, but I want to remind everybody, just go to the bottom of your screen and click on the chat box. And if you have a question, you can enter it there. I've got one question there now, but I'll go ahead and start with my questions, and then I'll read the ones in the chat box. First of all, how has this weather this week, how has that affected you guys?
It has affected us just like everybody else, not immune. The unfortunate thing is we had purchasers, gas companies, a lot of different kind of gas gatherers saying, hey, if you got any gas, then send it our way, we'll buy it. It's like, if we had any electricity, we could have our compressors running, or we could have our water disposal pumps running, and then we could send you some gas. But without electricity, we have a few other problems, so you're not getting any gas from us. So we're not shut to zero, but we're going to be, severely curtailed in terms of production volume. And until things warm up this weekend, we're not really going to know the extent of the damage. It's not like I see or hear reports of water running down the road, but as things warm up, we may see some, breaks in lines and things like that, or tanks that we need to go do some repairs on.
Okay. Then my next question, were you able to sell any of your gas at these $100 prices?
We will see when we actually get the purchaser's statement later in the month, or sometime in March. But some of our contracts are based on daily sales prices, and so if we could move any gas, we were getting some crazy high prices, and so I'm sure there's some of it that will be averaged in there, and we could have an outsized gas price for the month of February. Sure.
Yeah. When I was at Hess one time, we sold gas into the New York market at $60 an MCF when gas was like three or $4 an MCF regular. I actually thought that they screwed up and put the decimal point in the wrong place.
In the wrong spot. Yeah.
When I saw the revenue check, I was like, oh my God, how do we get this? Anyway, I bet
the opposite, Dan, the opposite to that is we sold some oil last year when it was negative, right?
Yeah, true. Yeah.
Sold some gas because Waha was so bad that it was negative, and we've had negative gas prices. So, hey, what goes around comes around. For every bad thing that happens, maybe a good thing happens, at least from a price perspective, and maybe we'll overcome some negative Waha pricing and get some a good price here.
Yeah, that's what I was going to ask you. Is that last year it was just terrible, especially on gas prices. What kind of differentials are you getting out there now? And assuming everything gets back to normal, what do you think your realized price on gas could be when things settle down?
Yeah, Waha has come in a lot. Like it was, at one point last year, on an average, it was minus 250 or something like that. So if Henry Hub was selling for $2, we were paying 50 cents to get our gas sold. Today, that's a lot better. And in fact, if you look at our hedge schedule, we've hedged the basis swaps using swaps, the basis at Waha, and minus 40 to around minus 40 cents for this year and minus 23 cents next year. So there was, I think, one day either late last week or maybe the beginning of this week where Waha was $2 higher. Outside of this big giant blowout in price, Waha was $2 higher than Henry Hub.
So you would get on your actual physical sales above WTI, but then you'd have to net out the differential?
That's correct. Yeah.
Okay.
So we see, next year being on a net basis. If the hedge prices are any indication, and they're not always because there's a natural cash market, but if there are any indications, we're looking at 275 net prices for next year on gas.
Oh, great. That'd be great. That's better, I think, than what I'm using in the models. This is a good point for me to tell everybody. All of the valuations on the stocks in my newsletter, my end of January newsletter, were based on much lower oil and gas prices for 2021 than have right now. And what I'm doing is every time one of these companies announces their fourth quarter results and their guidance for 2021, I'm going ahead and I'm putting in more realistic prices for the first half of the year. So anyway, on your production side, other than this week or two of curtailed production, was your production going to be pretty flat from your pro forma Q4 to Q1?
We were going to go down because the decline rate at the IRM assets are a little bit higher than ours.
Yeah.
And then secondarily, we had brought 6 wells on in December. But generally speaking, we're at 22,000 in the fourth quarter. We'll go down maybe a little bit, but not much. And bringing on 5 wells at the end of the first quarter, we'll probably keep the second quarter, again, in a little bit of a decline. The third quarter will probably start to have some completions. And then by the fourth quarter, we should be back up, at the higher end of our guidance and above it even in the fourth quarter.
Yeah. Are you still looking to make more acquisitions?
Yes.
All the time? Yeah.
All the time. I mean, we've got the integration going pretty smoothly on the IRM assets, and the people. We have the right to offer jobs to people. We don't need a whole lot of extra office support. We do need field support, and so we'll probably have some additional field folks that we'll bring on board. It's a small enough asset, and it was packaged and run by the company well to where it will be not a challenge for us to go out and do another deal. And the stars have to align. The financing or how you're going to pay for it has to line up well. The asset quality has to be there, but there's a lot of things on the market, and there's a lot of things that we do privately, knocking on doors, talking to folks, and feel really good about 2021 and the availability of opportunities for more consolidation.
Mm-hmm. Yeah, I know from my Hess days, sometimes after the acquisition, that like John Hess made, we find out a lot of stuff after we start rolling in the actual details by property. So
you always do. You always do. Yeah.
But a lot of times these acquisitions, I tell people, you get some great people. I mean, when you can cherry pick from their staff, you can really get some good people on your staff through these acquisitions. So it's another upside sometimes to these things.
Oh, no doubt. When we did the Bold deal in 2017, closed it in May of 2017, we picked up a handful, and I'm not going to point out exactly how many because I'll probably forget one or two, but we picked up some exceptional staff who have been with us since then and really are the structure and backbone of our Midland Basin operation. And it was really super. That part of the acquisition was very fantastic for us.
Yeah. And, a lot of times there's just a synergy. You get new engineers and geologists with different ideas, and, you just get some good stuff out of that sometimes.
It's all about the cultural fit. If you can find
people
that fit into your culture, it's a win-win because, they get more freedom and responsibility, accountability, and we as a company and a management team get exceptional employees.
Yeah. When Hess took over Transco, that's how we got to Houston.
Yeah.
I wasn't able to hire a single accounting person from Transco. Because they thought they were going to have to move to Tulsa. Well, then, a year later, we moved everybody back to Houston. And there was one gal, I offered her about 50% increase in pay, and she wouldn't even take it. But anyway, another question: is your Eagle Ford area for sale at the right price? Quote, right price, high price?
Well, everything we have is for sale at the right
right.
Exxon wants to come and pay us a 100% premium. We'll turn the keys over to them. Yes and no. And I qualify that by saying it's, again, not very large in our portfolio, but what it does for us, and we've got a great operating team down there and their company employees. And one of them, in fact, has been with us, like I mentioned earlier, over 20 years. It gives us a foothold. So if we didn't have it and we were looking at Eagle Ford deals, it would be difficult to jump in there and get the effective integration done. But given that we've got a foothold there, we've got some historical knowledge in the Eagle Ford, I like keeping it for a while. Mm-hmm. There are some opportunities in the Eagle Ford. I'm sure, see the list of the publics that are out there and some of the distress, as well as just privates who are selling assets. And we look at both there in the Midland Basin, probably equally. Midland Basin obviously is our first choice, but if I could find an IRM type situation that fit all of our criteria, then in the Eagle Ford, then we would participate in something like that.
Yeah, there's not as much tier 1 acreage, but there's some really, really good acreage. That's for sure. There's some really, really good wells in the Eagle Ford.
No doubt, and it's good cash flow.
Yeah.
And it just gives us more scale, and then we can take that cash flow and pay down debt, bring in a rig, look for more acquisitions. At some point, maybe there's even a distribution model that works depending on how big you get. I think we're obviously too small today, but agreed.
Okay, I'm going to go to some questions that have been typed into the chat board. Henry asked, what was the oil and gas prices that you used to value the IRM acquisition at 173 million?
Yeah, good question. And Scott reminded me that oil at the time was about $45.
Okay.
So, we're in a much higher price environment today, and that value of that asset is a lot higher. If you look on, I can't remember exactly what page it is. Let me see if I can get there real quick. My computer froze up. Makes sense, doesn't it? If you look on page 25, you can actually see that the proved developed PV10 is 200 million, And this is on $50 oil and $2.50 gas flat. So,
Okay.
an incremental 27 million over what we valued it at the time of the deal.
Yeah. And that additional $10, if you'd go to 60, probably about 85% of that falls right to the bottom line. So
Exactly.
that's really good. So, the other thing he says, asked us, did Warburg Pincus, did they make any profit on the deal?
You'll have to ask them.
Yes. That, yeah.
The fact that they didn't want 100% cash,
Yeah.
the fact that they had drilled about 50 wells, you do some math there, and what they got in the deal in terms of equity, they wanted to ride the upside. So.
Yeah, and they've made a bunch of money on the stock. I mean, the stock was what, about $4 when they did the deal, and now we're at 680. So with a lot more upside. I think when you guys issue your fourth quarter results, you're going to get some serious upgrades if anybody's modeling it anything close to what I'm modeling at. Anyway, let's see. The next question is that purchase now fully integrated into Earthstone? So are you ready to make another acquisition?
Yeah, I think we've already answered that. The answer is yes. We're ready to work on something else. Well, make another one. We're already working on several things, as we always do. We don't slow down. We've got a really good team who can evaluate deals pretty quickly, and the deals keep coming, right? I mean, there's a very active A&D market. There wasn't in 2020, but the beginning of this year, the past 45 or 50 days, a lot of deals hitting the street, and bankers and advisors are very busy. So, we will, like I said, we'll start reporting IRM in the first quarter in terms of results. We'll probably have some information in our K, but it won't be included in, revenues and P&L and balance sheet and that kind of thing.
Okay. That we got some questions in an email here. I think we've answered most of these. Any weather related operating issues? Has it been so cold that any hydrates formed in your wells and our pipelines? Have you had are the pipelines injecting methanol into the pipes? And if so, who bears the cost of that?
Yeah, that's a good question on the cost side. So anything we have to do to get wells going again is on us. So if we're buying methanol to inject to keep gas from freezing off, then that's our cost. And to be honest, today, I don't know if we're buying methanol to do that. Most of our compressors, I'd say most of them are truly electric. So until the power grid comes back reliably, if a well goes down or compressor goes down, we're not going to rush out there and try and put it back on just for it to go back down again. Same with electric submersible pumps. They consume quite a bit of power, and when west of Midland, starting whatever grid that is, going through rolling blackouts, we shut all those ESP wells in. There's no use having them start and stop. That's like your air conditioning unit starting continuously is really bad and hard on a motor. So we shut all those in when they went down, and we'll start bringing them back on probably today.
Yeah, I saw article by Reuters or something this morning, and they said that total production might have been down about 4 million barrels a day. I don't know if that's from all of the Permian, but they think that all but maybe 1 million barrels that'll be back online by the end of the month. That most people.
Yeah, one of the issues is when you get bad weather is if you don't have your saltwater disposal on pipeline or your oil on pipeline, then a truck's got to come by and pick it up.
Yeah.
You can only produce till your tanks are full, and then you're shutting things in. And so once your tanks are at some level, you got to start shutting wells in and hope those trucks show up. So for, since about last Friday or so, it's been below freezing in certain places, and including in South Texas, it's been cold. And so, we produced wells as long as we could. And then once the trucks weren't showing up, we had to shut them in.
And are those roads out there in pretty good shape? Because sometimes when this stuff thaws, you really got a mud situation too.
You hit it. In some cases they are okay, but you're going to end up with. And when the roads were icy, like late last week in Midland area, crews couldn't come to location if you had a well that was being worked on. They just not get to location. So
yeah, I tell you, when I was at Hess, our stuff up in North Dakota, from
yeah.
like April and May every year, you pretty much kind of had to shut down a lot of stuff because you couldn't even get to it.
Well, and you couldn't move rigs, right?
Yeah,
If
you can't move anything. Yeah.
Yeah, you had limitations on how much could move down the road. The advent of pad drilling and horizontals really helped that, right? Because
Right.
then go drill 4 wells and you weren't moving, and man, that the efficiency and the savings that had happened was great.
Yeah. Well, actually, this, you know, in my weekly podcast that I do, I keep reminding everybody that we're not even close to the number of rigs, the active rig count to stabilize U.S. production. I think we need to double our active rigs if you're going to see U.S. production ramp up again. And I don't know. I mean, the rigs are better. The really good rigs come on first, and you start drilling some of your better locations first. But I think we're at least 150 rigs below where we need to be just to stabilize production. So
Yeah,
anyway,
no,
it's going to be an interesting year, that's for sure.
It is.
Okay, that's all the questions that I have. I would just tell everybody, if you have additional questions, you can email them to me. Just email them to energyprospectus@gmail.com. Those go to Sabrina, but she sends them over to me, and I will forward them to Robert. And like you said, they're going to announce their actual fourth quarter results sometime in early March. They did put out a press release with an operations update a week or so ago. So that's in there, and that's what I use to update my own forecast model, which is sitting out on our website underneath the Sweet 16 tab. So that's it for now. Robert, anything else?
No, I just appreciate you inviting us, and I appreciate all the listeners. And you know, if you do have questions, our contact information is out there. You guys can shoot it through Dan, or you can shoot it to us. We definitely are shareholder friendly, very transparent, and we look forward to the day when we can do this in person once again. And it's just around the corner. So
yeah, it is. You know, we're sooner or later, all pandemics have to end, and I think we're about to escape pandemic world. We may not escape mask world for a while, but we're eventually going to escape pandemic world anyway. All right. Well, thanks everybody for being on this. We will email out the recording to all of our members globally, and we do have quite a few members in Europe that are buying into these stocks. So anyway, thanks a lot, Robert, and we'll end it here.
Thanks, Dan. Goodbye, everybody.